In this video, we will be talking about whether you should wait for a market crash to buy stocks, or if you should buy right now. Can we predict a market crash, or should we just keep buying as usual? But before we start the video and answer these questions, make sure to like, subscribe, and hit the notification bell for more content. And now let's get into the video. Investing money in the stock market can be scary for some investors. No one wants to buy right when prices are at their peak. And investing in the middle of a market downturn can be even more stressful. It is impossible to know if the worst is over or if there are more losses to come. So how do you know when it's the right time to buy stocks and when to expect a market pullback? The best answer is that you don't. Both passive index fund investors and individual stock investors are probably better off buying stocks and shares all of the time and ignoring the daily ups and downs of the market. Is now a good time to buy stocks? If you want to invest in your future, 5, 10, or 40 years from now is as good a time as any to buy stocks. Despite recessionary fears stemming from 2 consecutive quarters of negative US GDP growth in the first half of 2022, it is important to remember that markets are looking good to the future. Stock values are based on expected future earnings, and despite occasional dips in GDP, incomes tend to rise over the long term. However, there are still good stocks to buy in the middle of the recession. If you invest consistently over time and put more money into your investments each month, you will occasionally experience a correction or crash in the stock market. These are opportunities to invest more than usual if you can change the cash flow. Of course, it is not very possible to plan in advance for the unpredictable. If the market could predict a stock price crash, the crash would never happen. If you want to research stocks, it can be harder to find good buying opportunities when the overall market cap is rising. Fewer stocks have value relative to their underlying fundamentals, but that doesn't mean there aren't opportunities. It is always a good time to invest when you find a security that you believe is undervalued in other markets. On the other hand, you will likely find more opportunities to buy shares of undervalued companies during a major market downturn. These are great opportunities to do your research and buy stocks well below what they were a few months ago. Warren Buffett once said, "I don't try to predict the market. I try to find undervalued stocks." He doesn't care what the market is doing. If there is stock at a good price, it is worth buying, even if it adds up in the short term. Trust the research you've done for long-term gains. But don't forget about the company entirely. Always make sure your investment thesis is still valid. Even buying a growth stock with strong long-term potential near the top of a bull market is far from a death sentence. Although bullish prices tend to fall much more during a correction or crash, these periods can also be a catalyst for growth. Stock market economic events often present opportunities for companies whose management teams are focused on long-term growth opportunities. So even if your stocks crash, they can come back even stronger. This makes economic uncertainty a great opportunity for growth stock investors. Some investors may be scared off by a small price drop because they believe more losses are coming. In fact, it is much more likely to be a correction, meaning a drop of more than 10%, but less than 20%, than a market crash or a drop of more than 20%. Stock market corrections happen all the time. On average, once every 2 years. They can be a great opportunity to buy stocks when they are temporarily discounted. Why you shouldn't time the market. Some of the best investors in history were not interested in market timing. Warren Buffett and Peter Lynch have avoided market timing their entire careers. If they don't recommend it, what makes you think you can outdo them? Lynch put it quite bluntly, investors who prepare for corrections or try to anticipate corrections have lost far more money than the corrections themselves. Just looking at some statistics should show why trying to time the market is a big risk. If you put all your money in the S&P 500 index fund at the beginning of the century, the average return for the next 20 years is about 6% per year. This period includes the dot-com bubble and the Great Recession. However, if you miss the index's best 10 days during that period, you'll only earn 2.44% per year. You lose half of the market return. You never know when those 10 days will pass in 20 years, but you better have your money working for you when it does. That was it for this video. Hope you guys learned something, and if you want to see more content like this, make sure to like and subscribe, and check out the content on our channel, and we will see you in the next video.